All right, good morning, members. It's August 7th. This is the weekly review. Take a look at what happened, what we expect to happen. When we look at the markets from last week, another positive week. This is week 6 now on this leg higher. Consolidation week for 1 week, basically. But we get a push higher, right? And the big numbers, if we're looking at it from the perspective of the yearly, almost 9% on the Russell, 7% almost elsewhere, 4% on the NASDAQ. NASDAQ Index paying catch up now. If we move on to the technicals, there's really nothing negative here. I don't have a long show today, primarily because I don't think there's anything bad to say about what we see. So if I go back here, let me get this situated. If I go back here and look at it, ABCD targets on the upside on the S&P 500. Those targets definitely in range now. So we had that, coming off the bottom, the A to the B to the C, and now the C up to the D is about 21.95. I originally estimated, I think, 21.91, but you do the percentages and you can look on those numbers I gave you last week. The links are in the report again this week. That projects 21.95, about 12 points higher than where we're at. So the other thing that was significant last week is, if you remember, we had this big consolidation now for about 4 weeks. We try to break down, right? False breakdown to the downside and then jam it back up, and now we break it out of the top side. So my expectation here is that this thing is going to try to continue moving higher now that you've had this pause, this consolidation, primarily in the S&P, also in the Russell. The NASDAQ Index, as you know, those had continued to just push higher. They didn't really give it up. If I pull up, we'll just pull up the NASDAQ, the broader index, and there, it really wasn't much of a pause, a little pushback, and now the surge. These all have projections that reach quite a bit higher. I gave you those projections last week. You can click on the links and check them out. Those projections quite a bit higher than where we're sitting at today. And I expect now, over the next month or two, you're going to see these things just grind higher, and actually this week probably the same. And so, whether it makes sense or not, whether we think it makes sense or not, it doesn't really matter. The market's moving higher. We should try to keep riding that move as it continues. We got new highs for the year, joining the S&P here on the NASDAQ and the NDX. And if we look at the let me get this straight. Sorry, folks. If we look at it on the ABCD targets, right, the things that I would be looking at next is, where are we going next? I think that what we should be focused on is the ABCD targets on the S&P 500 being hit, and then that Russell going to take out that last breakdown bar. It's about 1243. Let me show you that number. I think those are the two key events that are next and that we should be focused on. So if I come back to the Russell here on a weekly, actually on a monthly, that breakdown bar is right here, 1243. I think that's the number that we have to look at and expect this market to try to target next. And so that's not much higher from where we're at, but that to me looks like the next area that we're going to try to go after. Russell's sitting at 1231, so it's not that far ahead. I think those are the two things for this week that should be the targets for this market on this continual grind higher. Prior week it was NDX earnings that held us up. This week it was more central bankers, ECB, kind of overdid it in terms of what was expected. I saw a number the other day that since the 2008 crash, we've seen something like 650 or plus, 650 plus rate cuts now. I mean, it's a huge, unbelievable number for a 7-year span, where usually you get rate cuts at the beginning and then they go away, right? And then you eventually see rate increases. There's no rate increases. It's all cuts, and it has been and continues to be. Not only that, you get all these QE programs. We wonder why equities keep going higher. Well, it's not hard to figure out. It's central bankers everywhere, all around the world, continuing to push out easier money, easier credit conditions, in the hopes of pushing growth forward. And what they're doing is they're seeing, money that they're putting out there going to other places, one of which is the equity markets. And how long it will continue, I have no idea. All I know is it has continued, and we shouldn't expect it to change at this point. Strong markets, and I said this last week, strong markets typically get stronger, and they don't let you in or out. Weak, strong markets up or down. This is a strong market, and they always tend to do this. All the news ends up being good news, right? It doesn't matter what it is. In other words, if we get a strong employment number, that's good news. If we get a bad one, that's also good news, because the central bankers are going to do more. And so it's like all news is good news. You can't help but go up. And yeah, you take a pause every now and then, but eventually you keep grinding higher, and that's what we keep seeing. Central bankers' focus, I can't help but continue to emphasize this is what's happening. The BOE cuts by 25. They put another 60 billion pounds of QE out there, and they do this new 10 billion pound business line. It was more than the government. It was more than the traders expected. That was positive. That was on Thursday. Then employment number on Friday, that was stronger, 255 versus the 185. And it did what we thought it would do. It pushed the dollar higher, pushed the precious metals and the bonds lower. I think those things will be temporary. In other words, metals and bonds will probably reverse and come back up again, just like we've seen before, as soon as we see any kind of worries return. But that's what we should have expected if we got a stronger number. The number wasn't huge. It was big, but it was in the range of what we've seen before on the upside, and so the market took it as a positive again. Next week, though, the data is going to just die down, and usually when you have a strong market and the data just dies down, you just see the market try to grind in kind of the vacuum. Earnings are almost over. Those are pretty much out of the view now, and now it's just the market in a positive tone here, wanting to grind higher during these summer months. What are potential scenarios? I think the best case is that we just blow through all these numbers. S&P gets over the 2200 level and pushes on to about 2230. The worst case is this breakout fails and we retest regen that doesn't hold. So in other words, if I go back over to the S&P 500, at this point you just broke a swing point high. And so now we know, the first thing we should look for is a retest regen off this swing point high. So the worst case, would be for, well, let's do the three cases again. The best case is this thing just keeps moving higher, blows out 2200, goes to 2225. Worst case is you come back to test this, you fail, and you start to break back down and start setting up a deeper retrace. I think that odds of that are not very good, but that's the worst case. What's the most likely case? Well, the most likely case is that we just see this market maybe do a little bit of a pullback, but grind higher and capture that 2195 number. So I expect this week we're going to see that grind continue and push us on up to test and reach those targets. And so about 2200 and then some sort of a retrace. Best shorter term trade, the early dip, if we get one. Any kind of early dip this week, if we don't shoot straight up to 2200, you take that and you buy it. The long-term trade is the same as last week. I don't really have any others. I think that we could look at some other places, but everything's bullish right now, and so it's very hard to tell what's really a better long-term trade. I think any of those trades, that we're looking at, like for example Equifax or any of those others, like even Google or Facebook, where you're looking at the strength of the general economic conditions here in the U.S. parlaying directly into some company. And so, Equifax benefits from that. So does Google. So does Facebook on advertising on both of those. Any of those probably continue to be good long-term investments as long as the U.S. market, economic market, right, continues to be the positive market in the world, and that it is. That's it for today. I don't really have much else to say. It's positive. I don't see any negatives. And maybe we should be concerned about the negatives. But if you look at the headlines, The headlines are always negative to some extent, and anymore they're extremely negative. I mean, you got all the big gurus telling you this market's going to crash. You've got Goldman Sachs, you got Morgan Stanley, you got all these companies coming out, investment bankers and so forth coming out and telling you that you really shouldn't have your money in the market. I mean, if anything, we should probably have all our money in the market because everybody doesn't believe it. And the wall of worry is what this market's climbing. Thanks for joining me. I will talk to you next time. Of course, keep you up to date during the week and keep the portfolios hopefully churning to the top side. Have a great one. And until next time, take care. Thanks. Bye.